call this a half episode of Canadian Investors Podcast. All the members of the podcast team is quite busy nowadays, and but we want to keep the conversation going. And today, just it's me and Nate. We're gonna have a quick discussion about investing styles and portfolio construction, and we'll see where this takes us. And hopefully, in the next week, we'll be back with another company. So to start, again, self-introductions. My name is Kuhn. I teach accounting at a university, and I would call myself a growth-oriented investor. I want to use my accounting training, right, which as advantage I can use to test my investing theory and to see if my stocks are on track to achieve the gains I'm after. But there's things that I struggle with in my portfolio, and we'll talk about that today. Nate?
Yeah, I'm a school teacher. I have a real passion for statistics. I wrote a book about education statistics, which does not make me qualified to talk about stocks. But I'm just an amateur investor who really likes to enjoy nerding out over this stuff. And I'm a little bit of a quant. I tend to ignore the qualitative stuff for the most part. I don't 100% ignore it. It's not as important to me. A lot of people really want to focus on that, well, this is the competitive advantage for the company. I tend to just pick businesses that I think have competitive advantages to begin with. And then I analyze them based on statistics. And then I try and pick which ones I think are the best based off that.
All right. Speaking of that,
yeah.
So I just finished, the little book that beats the market. So that was the little book that still beats the market, right? By Joel Greenblatt. Have you read that?
I haven't read that one, but what's funny? I entered in stock investing, my first instinct was index investing. And just because the laws of probabilities make it very clear that index investing is going to win. But then when I first started investing, I made a lot of money really quick index investing. And then the market looked super overheated to me. And I was like, you know what? I can't do it. I can't just stay as an index investor. And I started picking stocks. And then I started to beat the market. And I continued to beat the market consistently. And I think if I stop, I'm still relatively new. So I don't want to sound cocky here. If I stop beating the market, I'm going to go straight back into index investing. And we're in a bear market right now, very clearly. And as that bear market's been happening, I've been more tempted to index invest because I'm starting to think the index is looking attractive to me again, whereas before it looked unattractive. And I get the argument that it still makes sense to pick stocks in a bear market. You could even make the argument that it makes more sense. But from my perspective, it's a lot scarier picking stocks as everything's falling. When you think things are probably going to rebound, I feel it's very easy to pick the index. For me, I kind of the opposite. When everything's flying high, I'm I want no part of this. When everything's going down, I'm I jump in, which, is sort of a classic value investor mindset, to be honest.
Yeah. So I started investing. We'll go back to the little book that beats the market. This thing is relevant. But let's talk about history for a bit.
Sure.
I started investing in 2002. So it's in the high school, right? And you have I listened to this one guy. He's just a financial advisor, just ordinary guy, but he was actually brought to our class to talk to us about our accounting teacher, right? So I actually did take accounting in high school too. He's talking about Rule of 72 and introduced us to the book The Wealthy Barber. And so that, it did appeal to me. So I basically I invested at just I think $1,000 change dollars I earned after a part-time job a mutual fund. So there was still a mutual fund. ETF wasn't big back then. And it was actually in the throes of just the fallout from the dot-com crash, right? So I think by 2002 it was still crashing. So and I basically have been pretty passive. There's a period where I wasn't putting money into the market, for example, at the university or when I was doing my PhD. But otherwise, when I had income, I just put money into mutual funds or indexes, and it actually turned out pretty well. But fast forward to 2020, I did have the opposite. But I think it's a similar fear, but opposite. It's like when things were crashing, I had this it was very hard to sit on my cash and just watching it fall. It was easy when I didn't have a lot of money, but like with a bit more, it was hard because you have nothing to kind of to grasp on. Like it's basically you just like, oh, so we're gonna have to imagine the economy becoming better. I don't know how long it would take, but 2008, 2009, 2010 actually, it took 3 years. It was ugly. So I actually, following the coronavirus crash, I just did something that I never do. I just liquidated my portfolio in February 2020, right? So it's like, okay, so I timed the market brilliantly. But it was kind of mostly just a fluke, I would just say. Like I think if history were to repeat, the market may not even crash, or recover as fast as it did. So what actually happened was I timed the crash, but I couldn't time the recovery, right? Because the Fed injecting money into the market so much, and it went up 1,000 points, every day for the Dow. It sounded unbelievable. So I stayed out for a bit. Then I, around May or June, I put more money back in. So I still made money, but it wasn't as much. What it told me was just basically, this game is hard to play. Now you can just put the money in there forever, it's fine. But I actually have interest in some of the companies that's out there, like for example, Tesla, and I followed it pretty religiously, almost every day, following news and stuff. So I think through crashes, it's actually easier to hold on to individual companies because you can follow their stories. You know what the future, you can anticipate what the future might be for a company. But for the broad indexes, you got nothing to hold on to. So it's like you have trouble holding, when the market goes high indexes. Actually, like I think I have a similar fear is that I get too tempted to time the market, and I don't want to do that.
Yeah, I am guilty of timing the market. I do it a little bit. I try not to because I know it doesn't make sense from a probabilities perspective. Although I think I've been burned in the sense that I've succeeded in timing the market a little, and it's probably made me overconfident. I had sort of the opposite thing. Like 2020, at the beginning of 2020, I had been like researching stocks for a long time, and I was thinking about investing and buying in, and I was holding on to some cash just as I was like mulling over different strategies and thinking about it. And then the COVID crash happened, and it dropped 20%. And I was
perfect,
like,
right?
no brainer. The market dropped 20%. Every time the market drops 20%, it goes up 20%. That's just law of averages. And it's been historically speaking relatively true, with like one big exception.
Well, if it drops 30%, goes up at 40%, it's pretty much back even, right? Because the pace is lower.
Yeah. So like I just put all the money into the index, and then like the PE hit 44. And like as much as like I had bought into this whole dollar cost averaging index fund investing type thing, I'm also a statistics nerd and a history nerd. Like my degree is in history and education. And I looked back at like the history of the market in the S&P 500 PE, and there was only 3 times before it hit that high. And I was like, oof, every time it's hit this high before, it's crashed. And I think it's actually like, it wasn't, and I actually made a post about this on Facebook at the time. I said, like, we're in a bubble caused by like all this QE, but like that the bubble doesn't have to pop, because the market could stay flat and the earnings go up faster than the market rises, which is actually what ended up happening. And I didn't really predict that. I just said that was a possibility. Like a bubble doesn't have to pop the way people think of it.
Yeah, I think, I don't think I would disagree with you that earnings, PE was high, but you have to look at, like people were being calling inflation before inflation happened, right? And I was in that camp. I think, inflation is going to happen. So basically, I bet it's Tina, right? Because there's no alternative. So if you were to sell, into strengths, which is fine, right? But where else are you gonna put that money? Are you
Well, that's
whether you
what I
come
was
back in,
thinking.
or you're gonna watch it get eroded away by high inflation? So that's why I didn't sell. I certainly lost a lot of money, because I don't think we're necessarily in bear market. It's basically a bear market for some stocks, for example, the Nasdaq stocks versus, like if you look at the Dow, it didn't really fall that much.
Yeah, I will say like, so but that was what turned me into a value investor. Like I couldn't hold through a 44 PE index. So then I started looking for value. And, part of this was talking to people like you and Tom, but I got a lot more into growth and I started to understand the math of growth at first. Like when I first got into value, I was like, well, Canadian bank stocks are super cheap. They have a monopoly, but they pay a great dividend. What's not to lose? So I invest a lot in bank stocks. And that actually ended up working out really well for me because the bank stocks kind of followed the same path as the S&P, but it was delayed. So the bank stocks recovered slower than the S&P. So I bought the S&P at the bottom, sold at the top, bought the bank stocks near the bottom, and then I sold them at the top. And that sort of got me hooked on value investing. But like,
which is similar, so it's allowed me to bring the conversation back to the little book that beats the market. It's basically, the Joe Greenblatt is basically saying very similar to what you were doing, right? So basically the first screener is return on invested capital. So I think he defined it as EBIT divided by net working capital plus net capital assets, right? So you want a high return there. You're gonna pick the top, like 10% of the company or something. I don't even remember exactly. But then he's like, well, okay, we want to buy them at cheap prices. So then the second filter is PE. So you want to buy high return on capital companies by a low PE. And so that will actually, then I think those parts are not controversial, right? As all the value investors could agree. What is controversial is that, well, it's more of a mechanical approach. And then he proposes just, okay, we're going to hold on for 1 year. And then you just, you sell the stocks that, the price has gained. So it makes the PE higher. And then you're going to keep, go to the bottom of the barrel and then try to pick up bargains, right? And I think, so that is the magic formula. But to some people who would point out to, past decade, 15 years, all the growth of big tech is like, well, I think, a lot of companies, they don't compound like that, right? So if you follow the magic formula, you're going to have like amazing run in 1 year, and you would have sold Amazon, Google, Apple, right? And you may not get it back in, for a number of years. And so they may fall, they may go up and they may fall, but then the second time it goes up, like it's even greater degree, right? Mm-hmm. So it might be just better to hold on to these long-term winners. Which I think, I want to discover, but obviously that is hard, right? You're gonna pick a fair share of duds, before you hit one, that truly compounds, thousands of percent over, a decade or 2 decades.
Yeah, I agree with almost everything you said there, to be honest. And like, there's a danger there that, the market is sometimes right and momentum strategies can work. There's a guy in the Facebook group we both participate in who's really into momentum investing. And I messaged him about his returns, and his returns were lower than mine. And that was part of like my logic was like, his approach makes a lot of sense to me, actually. As someone who's like a quant, usually they're like the momentum strategies are more popular. But like, while it's working, it's easy to keep doing what's working. But like, I'm going to be honest, like since this year started, what looked really undervalued to me from a growth and value perspective at the start of January or towards the end of 2021 was stuff in the NASDAQ. So I'm like 50% NASDAQ right now. And the NASDAQ has not done great. I am still beating the market, but like, I'm not beating it by much. And like, the market is red and I'm red too. So I'm just less red than the index.
Yeah, you're in good company there. But what I think, and this is actually, for all my training and past success with index investing, like I should be more quantitative, right? But I do hold on to the thought that even though you can say, oh, okay, we're gonna back test some strategies last 20 years, and you'll find some successful strategies. For example, if you're gonna do return on capital assets and stuff, the physical kind. But I'll try to articulate this well. Is that the rise of intangible assets and how important that has become? It is some form of paradigm change in our times. So again, going back to the big tech, that a lot of the intellectual capital are not captured on the balance sheets, right? And like accountants should have written this book, but if you want to look it up, it says Capitalism Without Capital. Role of intangible assets in the 21st century. I think it's written by a couple of economists from British universities, and they did a really good job articulating how important intangible assets. For example, we talk about network effect and the flywheel of you just have to you gain the users, and that become like for something like Facebook, it becomes very difficult to. They become a monopoly of sorts, right? That position become very difficult to dislodge. So we are seeing more and more companies building their empires on software, and software. The true value of this is not captured, right? It's not captured on the balance sheets. So what you see is in the early years they have tons of expenses. Yeah. And then something flips, right? Something flips, and they hit the critical mass, and then their margins go through the roof. But often that's too late for people who are using certain formulas to identify the stocks. Now, people can still do well, right? Buffett bought the Apple in 2016 when, for some reason, investors didn't like them anymore, and he made a killing. So you can still make a ton of money if you're late to the party. But I think more people are looking for, get a foot in the door earlier ones. Certainly, you can get trapped by companies that weren't going to succeed. But it is a lot of times a few people, and it's not just, I guess, not a winner take all, but like a few winners takes all type of scenario, and often like you just need like one or two investments to hit within 10 total investments, right? Like you don't have to bat 50%, you bat 10%, and that's it. So I think the time have changed, and if you're using data from 50 years ago to try to approximate returns, what the returns will be for the next 20, 30 years, I think there's a lot of dangers there.
Yeah, I actually do a lot of back testing for my strategies. I do some swing trading and day trading, which I don't recommend. I feel like probably I'm crazy for doing. But I back test my strategies in Google Sheets. And not only do I back test my strategies, like I back test them with 10 different versions of different algorithms that I'm creating. And then I try them across different indexes. And I might spend months and months on a strategy before I go out and execute it. And I feel like that's not for the normal person. And I when I see a lot of day traders are like, oh, this is a candle and a stick, I'm kind of just because I've seen how hard it is when you backtest these strategies to execute. I feel like it does take some precision, it does take some accuracy, but I feel like this whole picking the one winner thing out of 10, I feel like that I've heard the Motley Fool guy talk about that strategy of being he focuses on tech venture, and he's not planning to get a 70% batting average. He's planning to bet on a 1 out of 20 chance, but he just wants to own enough of those lottery tickets that one of them pays off, and it works for him. And I think that strategy has worked over the last 10, 20 years. You can see it works. I think it's made it really popular with our generation. It's not a tactic I use personally. I tend to everyone says they only buy quality companies. And it's kind of a shenanigan thing to say, but it can be true. Like I tend to just pick stocks that are really on two really basic principles overall. Like I do some swing trading and like day trading, but like for the most part, I look for stocks that are at a fair price and growing. And I use statistics just to measure that. And I thought I was more like Warren Buffett as an investor, but I was recently listening to a talk by Peter Lynch, and he was describing how he picks stocks, and it was like identical to like how I do pick stocks, which is funny to me because like I'd never really heard him talk about it. Like I never really like I feel a lot of people like read books to pick their strategy. I just kind of did what made sense to me. And Peter Lynch was saying like he looks at the historic average of the PE. He specifically said he looks at the 5-year average, which is what I do often. And then he says he looks for stocks that are currently trading below their historic average PE and are growing their earnings at a fast rate. I'm like, that's like 90% of what I do. I do other things too, but like that's like the core of my strategy. And then I only tend to look at companies that I think have a competitive advantage. I'm not looking for cigar butts. And I feel like that's a big trap of the value communities. They look at these, crappy companies that are trading at 8 PE or something. And they miss the fact that it's trading at that for a reason. It's not a good company.
Yeah, I feel, it wasn't long ago I finished that book, but I still have misremembered something. But I get the sense that Lynch did really own a lot of stocks. And that's part of it because the fund was so big, right? And his philosophy, I think he's just more of a kind of scrappy investor, right? Like he's very agnostic of any dogma. He just says, oh, okay, for example, that's one thing. But I think he did invest in some cigar butts, or the way I guess you backtest this is you try to approximate human behavior, right? So we know the stock market is made of millions of actors and it's impossible to predict what they would do. But this idea of stocks falling back to historical PEs doesn't certainly have a flavor of that, right? Someone has to decide that is a fair price to pay after maybe a period of volatility that, Bell should be trading back at, 22 PE. And if you see it being higher, then it's a signal to sell. Certainly, I can't fault that. I guess there's no some strategies are better than others, right? And the better strategies work for a long time, and it'll work until it doesn't, right? So it sounds like it's just I'm saying much there, but so the idea is if you're still within the paradigm, then people are still thinking the same way, then yes, right? So without being too kind of like vapid, let's just use Bell as an example. So I looked Bell in detail. Basically, it's a 3-pronged beast, right? Like they have their media business, so they have their cable business, and they have their the mobile phone business. So the media business is a cash cow. So they basically they own CTV and they have channels and they peddle their own stuff, right? And basically they'll go to Bell Satellite, about not cable TV, but whatever that TV is. So they're selling that product to a population. They're not growing, right? Certainly the population is going down who are subscribed to this paid TV, but they're still making a lot of money from it. And certainly it's a slow decline as opposed to a sudden turn off the tap kind of thing. And then you have the mobile business. Basically, the Canadian market is pretty much saturated, but nobody's canceling mobile subscription anytime soon. So they'll it's an oligopoly. They'll have their big share of that, right? And then they have internet cable, which is certainly a necessity. So out of the 3 legs, I really like 2 of them, but I don't like the media business and the related cable TV business. So when would the paradigm shift? So I think one thing is you have like a deep recession where discretionary spending goes after your TV budget, right? And say, well, why am I spending $100 for TV? We can just stream, right? Let's try this, right? Even for the older folk. And so that's one thing. Another is, like a new technology in distributing internet, right? For example, starting from SpaceX. So that's one disruption. Now they said about they're not going to go after urban areas, but it has advantages given that it's low. I think it's low latency and it does cover the entire globe. So that's another thing. So you can trade Bell on 22 PE, 20 PE until the paradigm changes, and just have to know when to get out. Now maybe Bell will reinvent itself before all that happens. So some companies have the ability to do that, and some companies do not. Right? GE is the example that couldn't reinvent itself, but there's a lot of companies that did. So I guess I would just say that if you're going to invest in individual companies, you need to keep up with the story, right? At least the main revenue drivers, just to see what's on the horizon, and that's a difficult thing to do.
The hardest thing I think to do is to cut your losses on a company that's going down.
Okay. Oh yeah.
Because once you're down, you just want to wait it out, right? And there's times where it makes sense. So
yeah, I like urgent, losses feel weighs more on you than the gains. It's easy to give up on the gains.
Well, I'll throw this other. So like I rebalanced my portfolio in January, right before the crash hit. So my portfolio was all green, and I sold almost everything and completely redistributed and bought all new positions. And
keep going down, right? But
it was all red. And every time I log into my stock portfolio, I see just like a sea of red, and you're just like, oh, I'm failing. I'm doing terrible. And like, I'm losing less than the index is losing, but you're still sitting there thinking like, what have I done? Yeah.
It's impossible to outperform, the market every month, right? So
I tend to, so you and I have talked about this, and I think this is a difference between you, me, Tom, and Jake, because you guys tend to take positions that are more speculative than me. I think I tend to take less speculative positions overall and lower risk profile than you guys. And I do try to beat the index every month. Like every day I compare my portfolio.
Yeah, because you're always rebalancing, right? You rebalance way more frequent than we do, because you're using more of the quantitative. You have more new data coming in.
Yeah,
and that changes.
Yeah, and part of that is my strategy too, because I'm not trying to pick things that are winning 10 years from now. And I can admit, and like in a red market, the 10-year strategy makes more sense. In the green market, in the bull market, I feel like where everything's going up, my strategy is easier to execute, because if you're right, you get to see it faster. And that's the part that scares me about the bear market and why I've been indexing a little more. I'm not indexed investing, but I bought some ETFs and I've started buying more dollar cost averaging right now. And it's because I can't see if my strategy is working right now.
So certainly if you're going to trade a basket of stocks, and if you're not going, waiting 10 years, I certainly can't fault you for that strategy. I almost think, what 2020 have taught me is these violent downturns. So remember, when the market absolutely bottomed, I don't remember. I think it was probably end of March 2020. And they just snapped back, like a couple thousand, 3,000 points in 3 days. At that point, there were, I was remembering watching CNBC. It's like, well, you're going to find these kind of really stable companies that, the devices is fine, but for people with a full-time job, you're not going to have the ability, the time to do that type of analysis. I almost think after a violent pull-down, drawdown, it's actually fine to just buy the index, right? Because you can't lose. The risk is low and the reward is high. It's not as high as picking the biggest winners, but in a violent crash like that, and I think all the assets classes are almost correlated. There's nothing that went up, right? Except for maybe for bonds or gold at that point, but it doesn't matter which industry or sector you look at, they were going down. So it's just fine to buy a broad index if it, see the market, it was pulled, there's went down 30%, 20 to 30%.
I think
in the green market, in the bull market, I think, I want to be more selective, is because then I come back to my position, like philosophy, that I don't want to be tempted to timing it, right? If I believe in the long term, there's something, sorry for like grabbing the mic, but for the book, Psychology of Money, so they talk about, the nature of bubbles, and it's like people say bubble is so irrational. Well, how do you know bubbles are irrational? Like what the author, the theory was basically, there's two types of people. There's like these traders and there's long-term investors, right? So when you see stock going up, like just parabolic 10 times, it's those traders, right? They're all playing this game. It's like, like who's going to blink first, right? Because if you blink, you may just kind of like, miss the next leg up, but nobody wants to be the sucker holding the bag when it's just falling parabolic as well. And they all know they're going to be someone like that. They're all trying to play this game, not to be the sucker, right? So, like the musical chairs until the music stops. What's tragic about it is the long-term investor who doesn't know how to play that game gets sucked into that mania, right? And of course, the stock falls. It's like, it's a bubble. It's like, people are so irrational. It's like, no, everyone else is irrational. You are irrational, right? Even the trader who's holding the bag at the top is rational because, they played the game enough times and maybe come up alive. But for the long-term investor who just bought it blindly, thinking, that definitely represents the future earnings of the company, they're the ones who are truly irrational and they suffer. So for you, as a long-term investor, the best you can do is that when you identify something like that, just stay out, right? You don't even have to sell. Just like, okay, I'm still hopeful, like, the long-term trajectory of the company, but I'm not investing a cent more into this mania.
Yeah. It's funny. I feel like most people are either a short-term or a long-term investor, and I feel like I'm a medium-term investor. And I feel like almost nobody's in this camp with me, where like I invest within like year-long timelines in my mind of like, and it's not that I plan to sell at the end of the year. In fact, usually when I sell a position, I don't actually fully sell, I sell my profits, because the number one reason I sell a position is because I think it's overvalued. So when I think a stock's overvalued, I tend to sell my profits and buy a new position that I think is undervalued. And I kind of see that as hedging my bets, because if momentum stays on my side, okay, great. And if it doesn't, and the market starts to act more rationally, I can say, well, you know what, it's fine. I corrected for this anyways. And it just allows me psychologically to help that stress, because I find it stressful.
That's cool. Yeah, I think you'll definitely find a lot of common ground with the little book that beats the market. Yeah, you should read it. You find that, it's actually a lot of more people doing this than just me.
Yeah, maybe I'm not the only one. I just, everyone I know, like, they're either like a short-term trader and they're like, what are all you long-term investors talking about? It's so boring. And long-term investors, like, they talk in like these 10-year timelines, and I'm just sitting here being like, I have no idea what any company's going to do 10 years from now. And like, I look at the Yahoo Finance and they tell you like, what is the average predicted 5-year growth rate? And I consider that, but that's like, in my mind, I keep that in mind as like a screw up, fail safe. I try not to buy companies where the average analyst is not predicting good growth over the next 5 years, because I do want to be able to hold the company if there's a random change in the stock price or a variable I didn't account for happens. So I want to pick a company I'm okay holding for 10 years, but I'm not picking it with the intention of holding 10 years. I'm picking with the intention of, okay, next year looks like there's some good things happening for this company. It's undervalued. This makes sense. And if I screw up, I'm okay holding this company for 10 years. That's why I don't like cigar butts. Like, even if a company is 50% undervalued or 60% undervalued, and I don't like the long term of it, I'm still not going to pick it, just because like it, I think it's too much of a risk. And I feel like a lot of this is about risk management, in the sense that there's asset class, I think, have a risk class to them. You can see when the market crashes, it crashes based off the risk asset. Like we saw like Square like went way down, but Square was a more speculative stock. And that's why it went more down, I think. And I have those stocks in my portfolio that are more speculative and they drop more.
I think it just, the way we define speculative is just, it attracts traders who use, other type of information, right, to make these bets and get other people in a wager. So for people like me, just you have to kind of try your best to stay out of it. For me, I guess, for all the flack, Cassie Wood and ARK they have taken, first of all, there's one thing I really did not like about her fund, even though I'm still investing in some of them, is the frantic trading. I understand why she's doing it, but I think she still does it way too frequently. But in the recent week, I think, like it was just less than 5 trades a day, for across 5 funds, which is kind of like very normal. So I don't know what's going on, but I'm pleased to see it. The idea is in the long term, you're not only looking at earnings growth, because the earnings growth can be very deceptive, right? And if you just look at the earnings growth for Amazon, any year to 2 years stretch, they could be investing a ton and then they'll be losing money, right? And then they'll be having a huge gain in 1 year. They don't care about projecting the stable growth path. So for people like you, it's really hard, right, to use your strategy to hold on to a company like that. But it's more about identifying long-term kind of secular trends, where the world is going. And coming back to ARK, because they do have a very, very unique way of looking at how technologies will change our lives 5-10 years from now. And they do make bold predictions and bold bets, and I have no doubt some of it will be will be completely wrong, right? But with a strategy like that, all you need is 1 in 10 stocks to hit it really big. So it's a tough game, right? It's trying to identify, okay, so what in terms of business-wise, the technology-wise, they're advancing, and when do we get the glimpse of that in the 10Ks or 10Qs that truly shows? So, like use Tesla, for example. We know that Tesla is not a volume producer, like before 2021, right? So when they're investing in all these charging points, all these R&D, new technologies, new factories, how can they have high earnings? It's like mathematically impossible to do, right? But you're just hoping, okay, Tesla's not going to go bankrupt, and suddenly, when they started cranking out, 50% more cars, 70% more cars year after year, you start to see the operating leverage goes up like crazy. And suddenly, I have no doubt in a couple of years, it'll be in value investment territory, right? It'll be like Amazon in 3 years, and in 10 years, it'll be like Apple, in the PE where it's going to go, just because the volume's cranked up and they've already done the investment they can make. So it is a tough game. It's to kind of try to see through, okay, what's not being reflected in the earnings? Is there other things in the 10K that shows they're making strides in technology? And certainly accounting reports is not the only thing that you need to follow a company like that. That's certainly a struggle, beyond Amazon. I try to keep up with Square, and I do have my bets with the big tech as well. I don't think I need to, I don't think I need to follow those companies as closely. But then I have some more speculative bets with the companies I'm not too familiar with. For example, Stone, Mercado Libre, Coinbase, and those are relatively small positions. But sometimes I get pulled into by the story, and I don't. Even though I know I probably don't have time to check those, so I'll try to get rid of some of those weaker convictions picks, and maybe put some a little bit more money in the index just to park my money, because I don't like to put them keep them in cash. So that's what I'll try to do. My 2022-2023 resolution.
I don't actually disagree with anything you said, and I missed Amazon. And I missed some stocks like Amazon because of my strategy. But I feel like part of my strategy, in my mind, my strategy is really more about risk management than anything. I'm really just trying to avoid companies that I think could go have big losses. So when you have a company with like a really high P, like Amazon or Tesla, the growth is priced in. And then if the growth doesn't happen, then that stock is a real bad thing to hold, in my opinion. And it's sort of the same thing as like as a company with qualitative disadvantages. So I try to avoid that too. So, you know, we were originally planning to talk about a fashion stock today. And that's not an industry I want to hold just because I feel like fashion can be very fickle. So a lot of what I'm doing is just trying to avoid things that I think are potential risks. For me, the biggest risk is a company not earning profit though. When I see a company in the red, that's my biggest risk factor. And I understand the math on it. I understand that a company sometimes is going to leverage up. We as individuals can leverage up, look like we're in the red, and do better in the future. I totally get that. But it's harder to understand the mechanics of that, make the future predictions on that. So I tend to avoid it for the most part. I will say though, I think in the value community, the tech stocks are really underlooked. And I like a huge percent of my portfolio is in tech. And I mean, on the one hand, it's just qualitative that like, do I think the future is going to be in manufacturing, or do I think the future is going to be in improvements in technology? I definitely think it's going to be improvements in technology. I don't understand how anyone could look at the last 100 years and think that, you know, companies that are not evolving quickly and innovating quickly are not the future. I think it's very clearly innovative companies that are the future. And I think the other thing that people miss, like let's look at FANG specifically. Everybody points to FANG stocks being super overvalued, like all the time. And when you look at how
like,
fast,
well, if Google is at the same PE as like SP 500, how can you say it's overvalued? Like
people do though, right?
Right.
People do, and like I think it's actually slightly higher right now, but not much, right?
Yeah,
and
it was like around that, like when it fell to like 2,500. I was like,
yeah,
yeah, it didn't make much
it's sitting
sense.
around the same PE as Bell, and this is what bugs me. Like there will be people in forums being like, "I would never buy Google; that's way too expensive," and then they're holding Bell, and I'm like, oh, "Okay, but Bell is growing at like 1% per year, and Google's growing at like 20 to 40% per year on average, and they're sitting at roughly the same, you know, corrected price because that's what PE is, and I think that's what people miss. PE isn't
Yeah,
a
actually,
magic.
I don't think we'll get around to talk about portfolio construction. Certainly, it's a much deeper topic. But I think, yeah, you know, when you start comparing Google to Bell, in one aspect, it's fair, right? Because like money is a dollar is a dollar. It doesn't matter where you invest it. But people do try to kind of allocate their money to different sectors as a way to manage their risk. You may not agree with it, but certainly they're not going to agree with you just by saying, hey, you know, your Bell.
But you know what?
I should put into Google instead, because they're trying to allocate to telecommunications. Maybe they're trying to allocate to Canadian market, right?
Yeah, I get that, and like I think there's a half truth to it though, and there's a half truth in the sense that like you definitely don't want to have all your money in one industry, and certain industries are better for certain things. Like the telecommunications industry has basically acted like a bond over the last 10 years. It hasn't had as much volatility. It pays you yield. It's a safe place to park your money. But there are also people who think they're going to beat the index buying Bell and Telus stock. And I just doesn't make any sense to me. Like why mechanically, if you like break down the accounting of it, it doesn't make sense.
Well, they point out to say, well, you know, I beat the market in the downtimes, right? Like it's a low beta stock. You know, what do you expect? Certainly, yeah, time horizon is everything basically. So I agree 100% with you. Like if we're talking about like something, you know, like more than 3 years, I wouldn't, you know, like I would never choose Bell over Google, you know, at least at current prices for Google. Yeah. It's, you know, it's funny, right? Like, you know, you and I, we'll probably have at least 20, 25 years in investing. Now, if we're completely rational, if we're just kind of totally emotionless machines, right? investing machines. Hopefully it will be that, but you would totally disregard that risk. It's like, people say, well, I'm not using this money for 20 years, so why do I care? Just put in the highest return possible stock. Who cares about the beta, right? Like, it's volatile, it doesn't affect me, but it actually affects you, right? It affects, your mood. Like when you wake up and see a lot of green or a lot of red, it might affect other decisions you make. It's totally irrational, but it's just how people work, right? So as I become more, I don't want to say all kind of, so that you have more money invested. It's like, okay, like I can afford to lose a big chunk and still be fine. But at the second, it's like, well, I'm not that much better off at $1 more than, but I'll be a little bit worse off if I lose, $1. So the utility of additional dollar is not the same. So I started thinking about, okay, about hedging my bets or protecting my capital, even though I have 20 more years. If I just, put my money in the high beta stocks, the high return, and close my eyes, I'll probably do better than trying to, put my money in some of the safer stocks, but I still can't do it.
Yeah, but I do this. I do the same thing, but I think you're right. But I tend to like look at the risk of the market. So when I think the market is overheated, I tend to increase the low beta number of stocks in my portfolio and switch to safer dividend stocks, kind of like people would traditionally with bonds. And then when I think the market is like we've had a crash, or I think the market looks really healthy, then I do the opposite. So like right now, the market has been going down, and I've been like increasing my high risk positions. Because I think like, if the market, like for example, the NASDAQ was down 18% at one point. Most corrections are on average are 18 or around 20%. We could be looking at a recession, who knows, and that could backfire. But historically speaking, statistically speaking, it's a pretty safe bet to buy a stock that's our index.
I agree with you. I think it's you may be more of a robot than I am, but like it's hard to execute, especially knowing when exactly, like it's time to sell. I mean, if you have a specific PE target, I suppose. I mean, I held the BCE, had Rogers and Telos. I even called this like, well, between these three, Rogers had the best potential to gain, right? Like it was around like 52 at that point. Actually, no, like it was around 57. And I was like, well, it must be like 67, 68 now. But like I held those stocks for to basically be cash, right, in a downturn, so I can leverage to high beta stocks. And I did that on January 25th, right? But what did happen? Well, actually, I should just wait a month more, and those telecom stocks would have provided me with even more Google and Amazon. But I didn't. Obviously, I tried to do what I think was right, but timing wasn't perfect, and
it
you
is
just have to
hard
live with that.
I tend to use bank stocks as bonds, so I really love bank stock. So when I think the market is more risky, I buy more bank stocks. Like January 1st, I thought there's a lot of like bad things going on. I didn't think you could time the market, so I was going to go to cash. So I made 40% of my portfolio bank stock, which is kind of crazy, to be fair.
Yeah,
and then as the market crashed, I started selling bank stock and buying NASDAQ.
Yeah, you wouldn't call banks low beta, right? So maybe Canadian banks is relatively lower beta, but traditionally bank stocks have really kind of just gone up and down with the state of the economy, right? First time in recession, banks would go down, just the nature of their business.
Yeah.
So when
but I guess in my mind, they're very unlikely to go to zero. Like I can actually see a scenario where
there's a lot of things that are very unlikely to go to zero. I would say, if can you live without going to the bank, or you're using banking services? Maybe not, but yeah, between telecom and banks, I would still feel the utilities, telecom being utility being more safer. But it was the right call in this period. I'm just kind of, I think maybe you're oversampling from the recent, because the bank stocks were beaten up so bad, they were just kind of on this kind of long, like medium term recovery trajectory, and a little kind of like a little mini crash wasn't going to stop that. But if we do have no GDP growth, which means recession, I think banks will not be a safe haven. Yeah, that's just my thoughts.
Yeah, you might be right. I don't know, to be honest. I mean, my mind is more just thinking like from a, like, so one of the things I studied in university was poli-sci, and just understand like our banks are basically intrinsically linked with our government in the way our country is set up, in that they're a part of our monetary system, and the sense that they have certain parts of their system is guaranteed by the government. The fact that they have a functional monopoly in Canada and that we really only have 6 banks. It's not like the States where, you know, like I could see a bank failing in the States, like one of the big banks.
Well, they have failed. Yeah, they have let them fail before. Yeah.
But I can't see like Toronto Dominion ever going under.
Yeah, they're highly regulated. I mean, so this is the thing, right? If you kind of bank, sorry, the wrong word, but banking on government support in a time when it's really bad, it's almost what they're saying right now with the oil and gas companies is like, well, windfall tax, right? So if things are really bad but the government has to bail the banks out, it almost becomes like, well, there's a moral obligation for the banks to give up some of the profits because of their kind of chokehold on the economy. So then this may not happen, but I tend to see that as a wash. It's just like, well, okay, the banks need to be strong because they are actually done a good job mitigating the risk, and they actually have a healthy balance sheet, not because our government and democracy kind of depends on it. Because if it does, then it'll be treated as more of a public good, and they'll be taxed a certain way.
I'm going to be honest. I think Canada is a unique system in that our banks are really an extension of the state. They are private corporations that you can buy shares of, but realistically, they act like an extension of the state. And I think that protects them to some extent. So like when I say they're low risk, I mean low risk going to zero. Like Bell appears low risk because the beta is super low, because earnings consistently go up around 1 or 2% per year, because it consistently pays the same dividend over time. But like Netflix is going to or crush, I think, their telecommunications over the long term. I think their monopoly on the telephone.
Well, we're going to say if they just want to raise their internet prices, you don't have an alternative provider. I mean, yeah. So if their cable business money goes down, they will just raise internet. Like I don't see why we wouldn't pay for that.
But like, okay, so like, look, Bell its earnings are going up despite you would think competitive advantages going against Bell.
Yeah. And well, I don't see crazy growth from Bell. I'm just saying that I think they provide enough of a necessity. It's like if they really want to kind of like muscle their way to higher prices for home internet and your mobile service, they're gonna do it.
Yeah, I think. What I'm really just trying to say is I think there's a non-zero chance of Bell going to zero. I don't think it's high, but I think that it's not zero. But I will say one of the things that Bell has going for it too is it is a little bit like a functional monopoly in terms, and it could be seen as an extension of the state too in Canada. The sense that we have these like, realistically 10 corporations in Canada that are so low beta in the eyes of the public investor, that they pay these dividends, but they're just in every pension portfolio. And I would imagine most politicians own these stocks.
Yeah. So this is, maybe you can answer this question if you study the politics. What's stopping them? So we have 6 banks. I guess I wouldn't put National Bank on the same level as the other 5, but sure, we can't live without the banking system, but is it really that catastrophic that if you say Scotiabank just goes belly up and gets acquired, its assets gets acquired by another big bank? Unless you're diversified across all 6 banks, how can you be so sure that one of the banks
I think
it's never going to fail?
I mean, I think there's a couple ways to look at it. Like one, you got to think how many mortgages are owned by that, how many checking accounts are there. The fact that the government says once you get official bank status within Canada, that they guarantee you, I think it's $100,000 in every person's checking
Yeah,
account.
but that just can be easily transferred. I mean, right now it's just all computerized, easy transfer to another, the books of another bank. I mean,
Yeah.
what's
I
stopping
think,
from like one bank from failing?
another point you got to think about too is just because Canada has so few good stocks. Like when you think about it, like it's not like the States where there's like the S&P 500 where there's 500 big companies. Like there's a list. I forget every name on the list, but there's a list of 10 stocks that's been put out of high quality, like popular stocks in Canada that has consistently outperformed the S&P. If you just own those stocks in that portfolio, and they're all dividend stocks. None of them are high growth companies. Like CNR is one of them, Bell is one of them, Telus I think is one of them. Like the banks are all one of them, and like that portfolio has done really, really well. And like you go on like a Facebook group for Canadian investors, like I would say 50% of all posts are about the same 10 stocks. And I feel like the politicians though, they also own those stocks, right? Their grandmothers own those stocks, their brother owns those stocks. So they're not going to go and pass any law that's going to disadvantage the company that they own, that their mom owns, their grandma owns, that their pension fund of their kid owns. Like it's just, I feel like it's a built-in functional monopoly by the fact that we have so few big companies.
Yeah, and that, actually, like I don't want to sound bearish on the banks, and I'm not. If my retired parents have a windfall of say $200,000, I'm quite happy letting them invest in just a portfolio of these bank stocks and just get the dividends and perhaps a little bit more of maybe more growth. I think ultimately maybe that's true what you said about the politicians owning. Not only will they not pass laws that disadvantage these banks, but they will actually pass laws that disadvantage their competition. And actually, both sides of the same coin, I suppose. I look at it this way, right? So Canada being a stable democracy that's relatively liberal, that's still attracting immigration, and last I checked, it's still fairly highly rated among people who want to seek a better life and maybe escaping authoritarianism, escaping some kind of oppression from their countries, and they're willing to bring their skills and capital to a place, and then the banks will facilitate that economic growth through population growth, and basically because we do have a stable system, right? We don't have I think compared to the States, Canada's still seen as more moderate, and a lot of people think it's safer, right? Because we don't have so many people carrying guns. So to that extent, I'm optimistically bullish about the banking system as well as the real estate, even though both are expensive. I don't think over the long run you necessarily go wrong with them.
Yeah.
I think I'm just
not
more
bearish on
where I want to allocate a big part of my portfolio to them. Maybe just that's my fault, right? For seeking too much excitement, not enough stable growth.
I don't know. Like, I think it all depends. Like when I said I had January 40% of my portfolio in banks, that was like an abnormal situation for me. That's not something I try to keep it below 15%.
But given your strategy, you would swing back into them if their PE falls below historical averages, right? Like that's just basically how you would.
It would depend. So like it would also depend on like I think the real long-term money is in growth. And that's something I didn't understand when I first started investing. But like if a company can increase their earnings by 30% per year, as long as they have even a reasonable valuation, you're going to make a crap ton of money on that company on the long run if you keep that up.
It just Well Simple had it right. Like it's grow your money, get rich slow. Get rich slow doesn't mean that you won't have 1 year where you make maybe 50% gains on your portfolio. But for people who actually can capture that, they have to sit through maybe 3 years of nothing, right? Maybe the 50% becomes 100%, right? Like sometimes the growth can be spectacular, but then you have the years of nothing, maybe even negative returns. So just the ability to wait it out certainly is a skill. I think that's what I'm working on, trying to develop that, because like checking your portfolio every day, just think, oh, maybe I can do something. Usually that's the wrong move, right? Like just don't do anything. At least for my type of investing, like I'm not like crunching PEs every month and trying to figure out how to optimize my portfolio.
Yeah, I feel like because like when I talk, it makes it sound like I trade all the time. And
No,
I'm
I'm not implying that, but like some people do, right? Like you just do it in less frequently, right? But like it's a quantitative game, right? And it's still, like I think all stock investing is quantitative. It's just like you just don't do anything until like your stock 10x's, like that's kind of like the rule, right? Like if you really want to capture those stocks, and certainly if a the company management is misfiring and not doing a good job, then you cut your losses. But I think like you've played that game, just kind of like, well, sometimes the stock goes to zero, that's it. Well,
and
but don't shoot yourself in the foot, right? Don't shoot yourself in the foot by selling too soon, by shooting the real winners too soon. Because like if you say you have 4 stocks, right? One stock goes up 300%, it's like great job, and then you sell the other 3, like maybe one goes to zero, another goes to 50, the other 2 goes down 50%. You actually haven't made any money, right? You actually need that one stock to go up 10 times to make money. So don't get too trigger happy with selling the gains, because like if it starts, Peter Lynch would say, if the story is intact, right, the company is still growing, the stock will still have more to run, even if it have a temporary downturn. So you're just being able to sitting through those thick and thin. It's
I find it a lot harder psychologically to sit through the good times than the bad times. It's for me, like seeing those profits on the table, and especially if I think the valuation doesn't make sense anymore. It's real hard for me. But that's part of why I only take profits. I've had stocks, like I took profits on Ford multiple times because it just kept going up like crazy.
Not a growth stock, Nate. It's like,
no, it's not. That was a cigar butt basically I bought, but I bought it on the narrative, a very like opposite of what I'm talking about here. And that's actually still to this day my best performing stock, because I bought it like at the very bottom.
Yeah, it was like $4, $5.
Yeah, something like that, something crazy low. And then
I like to 30.
Yeah, well, I sold profits at 14.
Yeah,
and then it went up to 18, and I was like, Jesus, the stock normally sits at a P of 8 is like at a P of like 40 or something. So I sold profits again. It went to 22 after I sold the profits. I thought, you idiot. But right now it's sitting at $15, and I took my money completely off the table twice, reinvested in other companies that have gone up, and I'm sitting there thinking, whatever's left on the table, I'm just going to let ride. I'm not going to take profits a third time or like get scared of taking out, because it is what I've already taken all my money out of that company twice.
Yeah, I think those are always the best stories. It's like, like you sense an opportunity and you're able to get out. Like it's investing kind of like, whatever, it's just dinner talk, and then you get, you certainly, there's a lot of, I guess, strategy and mental energy involved. And certainly if you succeed, that's great.
There's a lot.
I think it just over the long run, we don't, it's hard to calculate what the return on the kind of that extra little bit of effort, right, the attention paid to those companies are, compared to holding on to something, maybe a long-term winner like maybe Costco, right? People will say, yeah, it's hard. Certainly, if you do this with enough stocks consistently, you make tons of money. It is a difficult thing to do, though. I think.
Yeah, I think the math is against me, and I backtest a lot of my strategies, and the best I've ever done, even in backtesting, is the 70% like accuracy rate. And like that like resulted in a huge return just in backtesting.
Well, the trick to that, I mean, certainly, like you should be happy with what you pulled off. That's great. I think it just the risk of that is like not controlling the position size, right? And not recognizing the dangers if you were wrong, right?
Yeah.
So
And
like it would be right, it would be wrong, but like you don't let that wrong in time that's wrong sink you, because like Ford literally could go bankrupt, right? But obviously they had a good customer base, and then they had a good narrative, and their balance sheet was not too bad. But yeah, so yeah, just playing that game, I think is rewarding both financially, psychologically, but does have that danger of some people.
I tend to be a lot more diversified than most people.
Yeah,
I'm not a concentrated guy. I don't like being concentrated because realistically, a huge part of my strategy is just all about risk management. And it sounds funny to be like the person's being like, yeah, I do a lot of trades and I'm all about risk management, because those two things, they don't really go together. But at the same time,
do. I mean, you trade, like people don't understand why they trade, right? So if you trade to kind of like reduce your risks, because you recognize them, that's fine. I mean, I didn't really manage my risk well with a lot of what happened in 2001. I just chose not to sell the stock, right? When they were up like 100%. Well, Tesla's up 300%. I didn't sell them, right?
Yeah.
But I think that's the right call. But there's a lot of companies that it was up 100%, 200%, and I just kept them. And now I'm down 50%. Think about that, right? It's and
when it's up 200%,
I would have done a better job managing my risk if I chose if I took some profits. So I don't want to put a negative kind of spin on the trading. Right? Yeah.
I'm actually like pretty bearish on trading on what I do. I feel like the thing is, like, one, I'm very meticulous, and no one here in this conversation would see like the amount of hours I put into like spreadsheets trying to like track this stuff and like figure it out. I really don't think it's a strategy for the average person. I don't think it's easy to replicate. And I think there's been an element of luck to my success so far. And like, I played with relatively small amounts of money compared to like the other people in this group that we have. So like if I had lost the money, it wasn't a big deal, right? And I typically only ever invest the amount of money I'm willing to lose. The exception being if I'm in index funds or like diversified across a very stable like index, like for banking, for example, diversified across 6 banks, like that doesn't bother me to have a large amount of money on. But like, would I put my entire net worth on like FANG? No. And I actually feel like if you put your entire net worth tomorrow on FANG, 10, 20 years from now, I feel like you'd probably have more money than I did for like equated starting positions. But like, in fact, I'm super bullish on Google in the long run. Like Google, if I had to own one stock, I'd be tempted to make it Google. But I would never actually do that because in my mind, the risk profile is way too high for doing something like that. So I like to own around 20 stocks. More than 20, it's too hard for me to track everything and pay attention. Even at 20, I find it hard to pay attention. It's a lot to track. But 10, I don't like the math on it. You have one loser that goes to 0 at 10. Does that ever gut your portfolio for return?
Well, I think 10%. Yeah, I think 10% is generally probably the max that someone can take to go to 0, right?
Yeah.
And I think, yeah, I look at some of the investment advice as well. Just hold 5 to 7 stocks you know really well. But yeah, I can't. Like certainly with the companies I'm investing in, I think there's more than, it's a high probability that one of them go to 0. I don't want to be 25% or 17% of my portfolio, except for Tesla. It's like I break all the investment rules I have with Tesla. But anyways,
Tesla is your Google, isn't it? You're just I'm super bullish on Google.
Yeah, I mean, yeah, I don't want to go into too much details on it. I think when you are doing something to ensure human survival, right? To help with human survival, it's very unlikely at this point, especially when now they're profitable and the cash flow positive in a big way, to fail, right? They may not reach the valuation other people are thinking about getting to, but it's actually impossible for me to see that they fail.
They
may not 10x, they may not 5x, but it's impossible to fail now.
I don't think Tesla's going to zero, beyond personally. I think I have a little bit of a bias against Tesla because I find Elon Musk really annoying. So it just makes me want to like hate on the stock. But I think it's a good company, Tesla. I just think that
it's overvalued, right?
Yeah, we had that conversation.
By all traditional metrics. But yeah, if it's if they grow their net income by 100% a year, we'll soon be having a different conversation. Anyway,
right.
I think
if they do that, you'll be very rich.
Yeah, well, I think maybe not that rich, but yeah, maybe if I have more money into it, right? Yeah, so it's fun.
This is not financial advice. This is me describing the crazy things that I do in my own investment process.
Yeah, it's all entertainment purposes. So yeah, with that, have a good night.